Progressive taxation is a system where tax rates increase as your income rises. It is built on the simple philosophy of ability to pay. The primary goal is for those who earn more to contribute a larger percentage of their income toward public services like roads, schools, and healthcare. A common misconception is that earning more money will lead to less total take-home pay. This is false because tax brackets only apply to the specific portion of income within that range. Visualize your income as water flowing into a stack of buckets. The first bucket represents your lowest income bracket. It has no holes, meaning you keep every drop of income that enters here. As the first bucket fills to the brim, it overflows into the second. This tier has a small leak, representing a modest tax rate on these additional earnings. Crucially, the first bucket remains full and completely untouched. Your base income is always protected regardless of higher brackets. Tax brackets are often misunderstood. Think of your income as water filling a stack of buckets. The first bucket has no holes. Any money filling this range remains completely yours, untaxed. Once the first bucket is full, the overflow spills into the second bucket. This bucket has a hole, representing your marginal tax rate. Crucially, only the new water, the income in this specific bracket, is taxed through that hole. The water safely in the first bucket stays untouched. A common misunderstanding is that entering a higher tax bracket reduces your total take-home pay. Let's look at the reality using our buckets. The buckets represent your income. As you earn more, your earnings spill into the next bucket. Bracket 1 is tax-free. Bracket 2 has a small hole, and bracket 3 has a larger hole. Notice that adding a hole to the third bucket does not change the water level or flow in the first two. Moving to a higher bracket only applies to the extra money in that bucket. Your previous earnings are always kept safe at their original rates. In the global economy, large companies sometimes shift their profits to low-tax jurisdictions. This allows them to bypass the progressive tax structures designed for social equity. Pillar 2 solves this by establishing a global minimum corporate tax of 15%. This ensures that no matter where a company operates, it pays at least this base rate, preventing profit shifting and promoting global fairness. Governments now look at total accumulated assets to address wealth inequality. Wealth taxation views your total net worth. This helps ensure that extreme concentrations of wealth contribute back to the society that fostered them. Recent experiments include solidarity surcharges. When total assets cross the €50 million threshold, a graduated surcharge helps fund public resilience. As artificial intelligence accelerates productivity, it fundamentally shifts how we define labor and income. This brings us to the concept of the automation dividend. By implementing a progressive levy on gains derived from automated systems, we can create a new stream of funding. This AI dividend isn't just about revenue, it is about social stability, ensuring that as machines handle more labor, the benefits are shared across the economy. To summarize, progressive taxation is built on the principle of vertical equity. By asking those with higher incomes to contribute a larger portion, governments aim to lower the Gini coefficient and curb wealth inequality. While critics often warn that high rates may drive capital flight, progressive systems remain a vital tool. They balance the need for economic growth with the necessity of funding public services and maintaining social mobility. Ultimately, these brackets ensure that as the nation prospers, the benefits are shared, creating a foundation for a more stable and equitable society.